Hi there. Many property owners assume lodgers and tenants are taxed the same, but HMRC treats them very differently.
Hello and welcome to This Explainer. What if I told you that something as simple as choosing between taking in a lodger or renting to a tenant could swing your tax bill by over £12,100? Seriously, it's that big of a difference. Today, on behalf of my tax accountant, a premier UK accounting firm, we're diving straight into lodgers versus tenants and exactly why the tax treatment is completely different in the UK for the 2026-27 tax year. If you're a UK landlord with 1 to 3 rental properties, or honestly even just a homeowner looking to generate a bit of extra cash from a spare room, this explainer is built entirely for you. Let's explore how this choice directly affects your wallet. Okay, let's dive into this. Choosing between a lodger and a tenant goes way beyond who shares your kitchen or who gets their own set of front door keys. It fundamentally alters your entire relationship with HMRC. Whether you're letting out a spare room in your main house or managing a separate buy-to-let property across town, the rules governing what you legally have to declare, what you're allowed to deduct, and how much tax you actually end up paying are just worlds apart. And getting it wrong in today's tax climate, well, it can be incredibly costly.
£12,100. Let that sink in for a second. That is the staggering potential tax increase a landlord could face purely down to Section 24 mortgage interest rules on a buy-to-let property, especially when you compare it to the old tax system. We're going to look at the exact real-life scenario that produced this figure in just a bit, but honestly, this number highlights exactly why understanding your tax status is absolutely vital for UK property owners today. You really need to know precisely which set of rules you fall under, because a simple misunderstanding could literally wipe out your entire annual profit. No joke.
So here's our roadmap for today. First, we'll look at the core dilemma, the spare room versus the buy-to-let. Then we're defining exactly what separates a lodger from a tenant in the eyes of the law. Next, we'll compare the vastly different tax-free allowances for the 2026-27 tax year. After that, we'll tackle those infamous Section 24 mortgage interest rules. Then we look ahead to the massive administrative overhaul coming with making tax digital in 2026. And finally, we'll cover your next steps with MTA. Let's get to it. Part 1. The spare room or the buy-to-let. So this is the core dilemma for the UK taxpayer looking to optimize their property income. You might naturally assume that rental income is, well, just rental income, but HMRC applies entirely different frameworks depending on the exact nature of the setup. If you have a buy-to-let, you're running a property business, and that is subject to strict deductions and thresholds. On the flip side, if you have a lodger, you might be shielded entirely from tax by specific government schemes. And hey, before you think you might be exempt because you live overseas, consider this fascinating fact from the source material. Did you know that non-resident landlords are also caught by these tax restrictions if their UK income exceeds the basic rate threshold? The absolutely crucial point here is that these rules cast a very wide net. Whether you're living in London or Lisbon, if you're generating property income in the UK, you need to pay very close attention, because HMRC certainly is.
Moving on to part 2, defining lodgers versus tenants.
Now, what's really interesting about this slide is that the difference between a lodger and a tenant isn't about what you call them in your contract. You could literally write lodger agreement in bold letters at the top of a piece of paper and have them sign it, and HMRC won't care. To understand why, we have to look back to a landmark 1985 House of Lords case called Street v. Mountford. Basically, the court established that a tenant is someone who has exclusive possession of a property for a defined term and pays rent. Exclusive possession is the key phrase here. It means they can lock the door and legally keep you out. That gives them a proprietary interest in the land. A lodger, on the other hand, merely shares your main residence. They don't have exclusive possession. You can enter their room to clean, change the bins, or do maintenance without standard statutory tenant notice periods. This strict legal boundary is exactly where the great tax divide begins.
All right, part 3, comparing tax-free allowances. We're shifting from legal definitions to the actual pounds and pence now, focusing on the vastly different tax-free allowances available for the 2026-27 tax year. If you take in a lodger, you can access the rent-a-room scheme. Under this scheme, the first £7,500 you earn from renting out a furnished room in your main home is completely tax-free. And if you own the home jointly with a partner, you each get a £3,750 allowance. So to put that into perspective, if you rent out your spare room to a university student for, say, £600 a month, that's £7,200 a year. Because that sits perfectly under the threshold, the exemption is automatic. You literally don't even have to ring HMRC or put it on your self-assessment tax return. It's entirely tax-free cash. Amazing, right? But now, contrast that generous $7.5 grand with a standard property allowance for tenants in a buy-to-let setup. If you have a separate rental property, your tax-free property allowance for the 2026/27 tax year is a mere £1,000. That is a drastic, staggering difference. And remember, if the property is let jointly, each individual can claim their £1,000, but it's still absolutely nowhere near the generosity of the rent-a-room scheme. The tax advantages shrink incredibly fast the moment you step outside your primary residence. When we place these two categories side by side like this, the fundamental differences become crystal clear. For a lodger under the rent-a-room scheme, you get that massive tax-free allowance, but the trade-off is you cannot claim any expenses. It's just a flat, simple exemption. Now, for a buy-to-let tenant, you only get that tiny £1,000 allowance, but you can claim allowable expenses like letting agent fees, insurance, and maintenance, which, can be a bit of a double-edged sword. Yes, you can deduct costs to lower your taxable profit, but it requires meticulous record-keeping. And crucially for a buy-to-let, your mortgage interest deductions are heavily restricted by Section 24, which limits you to a 20% tax credit. Mortgage interest simply doesn't apply to the rent-a-room scheme in the same way because, as we just saw, you can't deduct expenses there anyway. Now, before we delve deeper into Section 24, here's a professional tip for those of you claiming allowable expenses on your buy-to-lets. Never confuse a repair with an improvement. While general maintenance is deductible, capital improvements are absolutely not. So, for example, replacing a broken boiler with a similar modern equivalent? That's a repair. Building a brand new conservatory or HMRC spotting a high-end brand new kitchen masquerading as a routine repair? That's an improvement. Getting this wrong is actually one of the top 5 errors that cost UK landlords money, and it often triggers completely unexpected tax investigations. So be careful there.
Part 4. Section 24 Mortgage Interest Rules. If you're a buy-to-let landlord, this is the most heavily impactful tax rule you face today. It has completely transformed the landscape of property investment in the UK. Before Section 24 was introduced, you could simply deduct 100% of your mortgage interest from your rental income before calculating your tax. Well, not anymore. Now the calculation is a strict 3-step process. First, you have to report your gross rental income. Second, you calculate your tax liability on that total gross amount without deducting a single penny of mortgage interest. And finally, step 3, you apply a basic rate 20% tax credit for your eligible finance costs to try and reduce your final tax bill. Let's see how this actually plays out in reality.
And this brilliantly illustrates the problem. Take a look at a real-life scenario from our source data. Miss Allison. She has £60,000 in gross rental income and £40,000 in mortgage interest. So her real actual cash profit in her hand is just £20,000. She also earns $65,000 from her day job. Now, under the old rules, she'd simply be taxed on her £20,000 profit. Nice and simple. But under Section 24, HMRC calculates her tax based on the full £60,000 gross rental income. When you add that to her salary, her fictional paper income shoots well over £100,000. Because of this artificial inflation, she actually loses her personal tax allowance entirely. She's being taxed on money she never truly saw as profit. Even after that 20% credit is applied at the end, her net tax bill increases by a staggering £12,100, which is exactly the shocking figure we discussed at the start of this explainer. Her cash profit hasn't changed by a single penny, but her tax bill has absolutely skyrocketed.
Part 5. Making Tax Digital 2026. So, as if Section 24 wasn't enough of a headache, we have to shift our focus to the future. There's an upcoming administrative revolution that will completely overhaul how you report your property income to HMRC. They are rolling out Making Tax Digital, or MTD, for income tax, and the dates are fast approaching. From April 2026, landlords with combined gross self-employment and property income above £50,000 must comply. By April 2027, that threshold drops to $30,000, and by April 2028, it drops to just $20,000. I want to strongly emphasize the word combined gross income here. If you're a UK landlord who also earns, say, $40,000 as a sole trader or freelancer, and you pull in $15,000 from a rental property, your combined gross crosses that $50,000 threshold. You'll be caught in the very first wave of changes in April 2026.
So what does Making Tax Digital actually require from you? Well, the days of handing your accountant a carrier bag or a biscuit tin full of crumpled receipts every January are officially over. You will be legally mandated to use MTD-compatible software to keep digital records of all your income and expenses. Furthermore, instead of filing one annual tax return, you're going to have to submit quarterly summary updates to HMRC every 3 months, followed by a final end-of-year declaration. It is a massive shift in compliance and record keeping, and it demands your immediate attention. Finally, Part 6, Next Steps with MTA.
Look, these tax rules are incredibly complex, and the administrative burden is only getting heavier. But the good news is, you don't have to navigate this maze alone. And actually, just as a quick reminder of how many hidden traps are out there, please don't forget the 60-day capital gains tax rule. If you sell a UK residential property that isn't your main home, you only have 60 days to report and pay any capital gains tax owed to HMRC. It's strict deadlines exactly like this that prove why having deep professional expertise in your corner is absolutely non-negotiable.
Before we wrap up, I just need to give a quick disclaimer. This explainer is for general information purposes only and does not constitute tailored financial or tax advice. You should always consult a professional regarding your specific circumstances, and honestly, that professional should be my tax accountant. They are absolute experts in property accounting, Section 24 mitigation, and getting you fully prepared for making tax digital. Give them a call on 0208 570 8531. That's 0208 570 8531. You can also drop them an email at info@mytaxaccountant.co.uk or visit their website at www.mytaxaccountant.co.uk. I'm going to leave you with this final provocative question to think about. Are your property taxes truly ready for the April 2026 MTD revolution? If you're a landlord feeling overwhelmed by these 2026/27 rules, reach out to MTA today to secure your financial future. And hey, if you found this explainer helpful, please hit that subscribe button on the MTA YouTube channel for more essential step-by-step tax guidance. Thank you so much for joining us, and we'll see you in the next one.